seems like none of you have finished the survey. I actually can have an up-to-date response, and it's not updated. Okay, so if you don't want to do it now, make sure you do the survey at home, right? So your feedback's really important. Please evaluate the course and the instructors. All right, so you may have seen me during the midterm exam. I'm the LSE of the course, and this week I'm just because Raphael helped me with 1 week. This is just the payback time, so I'm just substitute Raphael for this week. So what are we gonna do today is we're gonna talk about we're gonna go through 2 topics today. So we're gonna finish the last risk topics, sovereign risk, and then we're gonna talk about securitization, right? So my plan is we probably spend about half an hour on sovereign risk because there isn't too much things to talk about for sovereign risk. And then we're going to spend most of the time on securitization, right? So what we're going to do is I will give you a brief introduction of the securitization process, make sure you understand how it works. And then we will talk about different types of securities issued from the securitization process and different features, how do we price and evaluate those securities. So that's the plan. Before that, as usual, that's what I usually do in my other lecture sessions. I will give you a brief summary of last week's material, right? So last week we talked about capital adequacy requirements. It's a very important set of rules that regulator impose on banks to monitor and regulate banks' risk-taking behavior, right? So I will just go through the key concepts and I will emphasize on the important things. So basically, the first thing we talk about is the main functions of capital, right? So that's the reason why we impose strict capital adequacy requirements on banks. So this is because capital have important function to help banks absorb losses, so prevent them from being bankrupt before huge losses, unexpected losses are realized, right? So because of all these important functions, we have capital adequacy requirements, and we also discussed different accounting methods we can use to measure the amount of capital of a bank. So basically, the conclusion is, in practice, we will need to rely on book value accounting with relevant adjustments for the valuation of capital of a bank. This is because market value accounting, although it's very accurate, but it has a lot of issues, right? So these couple of slides talks about the problems with market value accounting and why we still base on book value accounting for most of the rules. And we talked about some background of the Basel Agreement because most of the regulation we talk about will be based on the Basel Agreement framework. And also in Australia, the APRA impose those requirements closely follow Basel agreements, right? So we talked about the background. So when was the first time the agreement was initiated? So the key is these agreement, right? The Basel Agreement primarily works as a guideline for regulators around the world, right? So it's just setting standard requirements that provide some ideas for regulator, and then regulator will determine how we can apply these set of rules to our local market. So different countries may apply Basel agreements in different ways. And we talk about how it was first initiated, what are the general rules, and how under Basel II there are several improvements. In particular, they add requirements for operational risk, right? And we will be focusing on Basel III, and you need to know the detailed rules recommended under Basel III about how to calculate capital ratios for a bank, right? So basically, another thing you need to know is under Basel II as well as Basel III, there are three pillars. So the first pillar is mainly talking about the minimum capital requirements, the detailed rules that require banks to use to calculate their ratios, right? And we will also be primarily focusing on Pillar 1. And there is also a second pillar, Pillar 2, which emphasizes the importance of regulatory supervisory review. So the idea is we require banks to set an internal monitoring system, and that system is also linked to domestic regulator. So in that way, the banks internally monitoring their risk management team, and the regulators also have an avenue to monitor the banks as well. And Pillar 3 is about disclosure, right? So we require banks to not only comply with the rules, they also need to disclose information about their risk-taking, about their capital, all the ratios, right? So that's something about the pillars. And in terms of calculating the capital ratios, these are the 4 ratios that banks need to calculate and comply with the minimum requirement. And you need to know how to calculate these 4 ratios. You need to know the formula, and you need to know the definition for different tiers of capital and how do we calculate risk-weighted assets, right? So in terms of capital, we have different tiers of capital. We have CET1 capital, which are the core capital. So the definition of these ones basically is the ordinary way we define capital, which include common stocks, return earnings, minority interests, right? And we also have additional Tier 1 capital. So they include some special types of preferred stocks, and they need to be qualifying in order to be classified as additional Tier 1. So there are strict rules in terms of how different items on the balance sheet can be classified as CET1 and Tier 1, right? So, but in terms of preferred stocks, there are many different types, and some are additional Tier 1, some are not. So I don't expect you to be clear about that. It's actually quite complicated. So you don't need to worry too much about how to classify preferred stocks, but you do need to know that we have special requirements for certain types of preferred stocks to be classified as additional Tier 1 capital. And then we have Tier 2 capital, right? So when we talk about Tier 2 capital, they start to be a bit different, because now we're talking about items on the bank's balance sheet that are not equity ordinarily. They're not equity, but they can help banks absorb losses when the bank actually becomes insolvent. Right? So it's kind of like considering items that can help banks absorb losses under a going concern basis. So it starts to include convertible debt, subordinated debt, as well as loan loss reserves. Right? So to understand loan loss reserves, you need to know a little bit of accounting. So that's a contra asset account sitting under the asset side of a bank's balance sheet, right? So they are so that comes from accrual basis accounting, and they are reserves set aside by the bank to cover future expected loan loss. So those loan loss haven't been realized yet. We just put reserves aside for conservative purpose, which means during adverse scenario, we are able to use the money to help banks absorb losses, right? So that's the idea of all these tiers. And if I give you a balance sheet, you need to know how to classify different items under those CET1, Tier 1, Tier 2 capital, right? And in terms of the denominator of those capital ratios, we have risk-weighted assets. You need to know how to calculate credit risk adjusted on balance sheet as well as off-balance sheet assets for a bank. And basically, so these are the formulas of the ratios, and these are the minimum requirements recommended under Basel III. And in Australia, the APRA also implement exactly the same set of rules on Australian banks, right? And for on-balance sheet credit risk-adjusted assets, this is the formula you should use. So basically, you need to assign a credit risk weight for each asset on the balance sheet and then multiply the weight with the balance of the assets. And this credit risk weight reflects the risk of the asset. So basically, the higher is the risk of the asset, the greater is the weight, right? So the purpose of using this credit risk adjusted assets as the denominator of our capital ratio is that, in a way, if we have a bank with very risky asset portfolio, their denominator, credit risk-weighted assets, will be very large because the risk weights are large, right? In that case, to comply with the same minimum requirement, that bank needs to keep more capital. So essentially, it's a very smart design because we are able to set one set of rules, but for different banks to comply with the rules, risky bank requires more capital in absolute value. Less risky banks keep less capital, right? So that's the idea. And another thing you need to know is what factors determine risk weight of an asset, right? So basically two things. One is the risk level of the counterparty. So they include, like if the counterparty is a government, basically the risk weight gonna be lower, right? If the counterparty is a risky private company, the risk weight gonna be higher. Another thing that determines the risk weight or affect risk weight is whether there is any collateral backed by the debt, right? If there is collateral, it's safer, lower risk weights, right? So you probably should have seen the tables that show you examples of the risk weight. Cash have a risk weight 0, securitization risk weight 12.5 times, right? So very risky. And you also need to know, here is an example about how the less is the collateral, right? The higher the loan to value ratio, the higher the risk weight. So that's the thing you need to know, but don't worry about the exact risk weight. You don't need to memorize these risk weights for the purpose of the exam, because different countries apply different rules, and those risk weights also changes over time. It doesn't make sense to ask you to memorize these weights, but you do need to know the idea of the risk weights, the concepts behind how we determine those risk weights, right? So that's something about this. And for off-balance sheet assets, the rules get a bit complicated, unfortunately, but you do need to be clear about how these rules are set and applied, right? So for off-balance sheet items, you need to use slight different rules for contingent guarantee contract and derivative contracts. For contingent guarantee contracts, including line of credit, loan commitment, guarantee letters, right? So those kind of contracts. So basically, the first thing you need to do is you need to convert the off-balance sheet amount into an equivalent on-balance sheet value, right? So we know that they are off-balance sheet. Even the face value can be large, there is a probability that they will never be realized on balance sheet. So what we're trying to do is we multiply the face value of the contract with a conversion factor, and this conversion factor reflects the probability that the off-balance sheet letters gonna be bring on balance sheet, right? So essentially, the higher is the conversion factor, the greater the likelihood that the off-balance sheet items will become on balance sheet. After that, we start to apply credit risk adjustments, right? So you multiply the credit equivalent amount with the risk weight of the counterparty. Depends on who is the other side of the contracts with the bank, right? So that's contingent guarantee contract. For derivative contracts, the rules get slightly more complicated. So again, the first steps involves calculating a credit equivalent amount. So you convert off-balance sheet value to on-balance sheet values. And the second steps, again, gonna be multiplying the risk weight. But this time, for most derivative contracts, the risk weight will be just 1. So which means you don't need to worry too much about step 2. But in terms of step 1, you have 2 components, potential exposure and current exposure. Potential, and one thing you need to be aware is what we are trying to do about derivative contract is derivative contracts are most for hedging purpose, right? So for banks, we don't worry too much about fluctuation in the value of the contract itself, but rather we are afraid of counterparty default risk. If the counterparty default, we lose the protection, we're going to suffer loss. Right? So that's what we're trying to do. Potential exposure captures how much we probably will lose through the life of the derivative contracts if the counterparty default, right? So what we do is you take the contract size of the derivative contracts, multiply by a conversion factor, and this conversion factor reflects the probability that the counterparty will default in the future, right? So that's potential exposure. Current exposure talks about how much we might lose today if the counterparty default or if we have to replace the contract today, so current exposure. And here we have a term called replacement cost, so which reflect the cost bank needs to pay today to replace the contract. So if the cost is high, so the more is the cost, the more you need to add into the calculation of credit equivalent amount. But there is another issue is sometimes your derivative contracts may be in the money, so which means if we replace the contract today, we make money, right? So we have profits. In that case, mathematically speaking, replacement costs are going to be negative, right? So we're making profits. It's not a cost. So in that case, the regulator says you can't deduct that benefits from the credit equivalent amount. You need to set replacement cost to 0. So that's just a slight bit more about how do we determine current exposure when you calculate credit equivalent amount, right? So these are the rules you need to memorize for the calculation of the capital ratios. So we do have a practice on the slides and several practice on the problem sets. Make sure you go through those practice. And in the end, we talked about additional requirements under Basel III, right? So we talk about several capital buffers. So those buffers work in a way that over time, our economy comes with cycle up and down, right? So regulators should keep an eye on our current economic condition, and we should impose or withdraw buffers when our economic conditions are good or bad, right? So because during crisis, banks will have extremely hard times, right? It will be very basically impossible for them to raise capital and keep the minimum requirements. So we should withdraw the buffer. During good time, it's easier for banks to raise capital, and it's also, so it's reasonable we ask them to keep more capital for safe, so that it helps them go through the bad times, right? So capital conservation buffer says if we are around the upper hill of the business cycle, regulators should ask a bank to keep additional capital on top of the existing CET1 capital ratios, right? And that should be a buffer ranging from 0 to 2.5%. And currently in Australia, we have a 2.5% capital conservation buffer. Another buffer is this counter-cyclical capital buffer. So from the name, counter-cyclical, right? So this kind of buffer are usually announced by regulator when we are at the peak of the business cycle. So when the regulator believes we're having bubbles, we need to slow down the economics, we should ask banks to keep more capital. And in terms of application or imposing, how we impose the buffer, it works in exactly the same way as capital conservation buffer. So it will be an additional buffer ranging from 0 to 2.5%. At the moment, around the world, most countries haven't imposed any countercyclical buffer yet. as well as in Australia, they remain 0. And Basel III also recommend imposing buffer on globally systematically important banks, GSIBs, right? So they are very big multinational banks. They are too big to fail, so we should require them to keep more capital. And every year, the organization will update a list where they classify large banks around the world into different categories, and they are subject to different capital buffers, right? So in Australia, they have their own rules. So they have their domestic important banks. And of course, they are the big 4 banks, right? And they are subject to 1% extra CET1 capital ratio. And the last one is this leverage ratio. So the leverage ratio is first recommended under Basel III, so it's a new thing. And this, if you look at the formula, this time we don't do credit risk adjustment anymore. So the denominator is total exposure. So it's the total book value of a bank's assets plus total value of their off-balance sheet assets, right? So no risk adjustments. So basically, it's just a simple leverage ratio, right? So the higher this leverage ratio, the lower is the bank's leverage, right? So because the denominator is capital. So the idea is we should bring explicit requirements that restrict banks' risk leverage taking, right? So yeah, so that's this one. And another thing I want to emphasize is all the rules we talked about just now about adjusting for credit risk. So essentially the rules helping or restricting banks' behavior in terms of credit risk exposure. Throughout the semester, we've talked about different types of risk, right? So there are specific rules that restrict banks' liquidity risk-taking behavior. Recall that in 2 weeks ago, we talked about LCR ratios and the NSFR ratios. They are remedies or requirements also required under Basel III, right? And there are also capital requirements for market risk. So how it is imposed is basically the bank estimate their market risk exposure, and then they calculate a percentage capital, add-on capital, given that market risk exposure. Same thing applies for their operational risk. So for this course, we haven't talked about operational risk in details, but it's a risk that has attracted a lot of attention from the regulator. So that's just how the Basel Accords actually considers different risk of the banks, right? So yeah, so I think CBA today they announced the new financial reports for 2019 financial year. So this is like last year's financial reports. All right, all good. Any questions so far? So any questions in regarding to capital adequacy requirements? No? All right. So yeah, so along the way, I really don't want to be the only guy talking in the room, right? So that's the worst. It will deliver the worst learning experience for all of you and as well as for me. So make sure you stop me and ask questions along the way, right? So so let's just talk about our learning objective today. Start with sovereign risk, right? So sovereign risk has another name called country risk. So basically what we are talking about is we know that banks lend money to foreign firms as well as foreign government all the time, right? So when there is some bad things happen to a country, like civil war, like strikes, or monetary policy changes, right? Something happens, something wrong with a foreign country, it will affect a lot of things, especially it can affect the country's government to pay their debt. It will also restrict local firms' ability to pay their foreign debt, right? So today we just talk about how those bad things all together, we call it sovereign risk. And it's a very significant problems for most international banks because there are very limited remedies to deal with sovereign risk. Okay? So we're talking about a government. Individual banks can be quite weak when this kind of situation happens. But and what we're going to do is we're going to discuss the difference between sovereign risk and credit risk. And then we will discuss different types of sovereign default. Finally, we will talk about how do we evaluate a country's sovereign risk. So we'll talk about that. So generally, if you think about it, we are talking about the ability of a foreign government, foreign firms to repay their debts. So essentially, it sounds very similar to credit risk, right? So we're talking about the borrower's default on the loan. So actually, sovereign risk and credit risk are closely related, but sometimes they can be independent, right? So when we talk about credit risk, we're essentially mainly focusing on the borrower's own credit worthiness, right? So it's analyzing the own firm's ability to pay their debts, their earnings, and all that, their performance. But when it comes to sovereign risk, it happens that sometimes even the foreign firms have the ability to repay their debt. If their governments have some problems and they restrict local governments from local firms from paying foreign debts, it can still be an issue, right? So sometimes sovereign risk can be independent from credit risk. So these are some recent examples of sovereign risk default. So during the 70s and 80s, there were large waves of government default in the South America region, so like Brazil, Latin American countries. They all claimed sovereign debt default, so deferred paying their government debts and interest for their bonds, government bonds, and all that. And you see how during that time, Citicorp set aside additional $3 billion in reserves, in loan loss reserves, right? So you could have a feeling that when a government claims sovereign default, that could mean huge, huge losses for the banks, right? So it can be very dangerous. And during the late 80s and 90s, we had the, again, that's something linked to that event. And more recently, we have during the 90s, we have the Asian crisis where Russia almost default on their debts. And later on, we have the Turkey and Argentina default on their debts. And even more recently, actually, I think it's still having some effects today in Europe, right? So in 2012, so a few years after the GFC, a couple of European countries default on their debts, right? So it's actually a very big event happening during recent years, and it was actually out of a lot of people's expectation. So Greece, Portugal, Spain, Italy, they all default on their sovereign debts and required IMF's assistance and the delay of the payments and all that. I think until last year, Greece will still not be able to fully go back to normal state to pay their debts, actually. So it's actually a very big event happening for like several years, right? So I give you a couple of links about this event. If you're interested, just have a look at them. And yes, and also there is an interesting video on YouTube. If you search European debt crisis visualized, there is a very interesting video that talks about the background of the events. So it's actually related to monetary policy, fiscal policy, problems with the European Union, and cultural kind of things that lead to this crisis. And when a country claims like a default, there are usually two things gonna happen. One is they can choose to claim a debt repudiation, which is a very, very bad thing. So basically the government says, I refuse to pay any outstanding foreign debts. Okay? So this kind of events rarely happen nowadays. It only happened since the Second World War. Only 3 countries has declared that repudiation, and they all involves change of government, right? So China, Cuba, and North Korea. So after the Civil War, they changed new governments and they refused to pay foreign debts. And most of the time, when a country find difficulty to repay their debts, they announce a debt rescheduling, right? So that means they talk to the lender and say, hey, I'm not able to pay the debt. Can you give me some concessions? Give me some time, right? So negotiate the terms and reschedule the debt payments. So we've talked about most all of the sovereign debt defaults we talked about just now end up being renegotiated and rescheduled, right? So that's just a little bit different forms of sovereign risk. And this is a little bit discussion about why nowadays we rarely see any debt repudiation, but rather debt rescheduling, which is a good thing, right? So this is mainly because nowadays most sovereign debts are in the form of bank loan instead of bonds, right? So if we talk about bonds, basically we're talking about the issuance of thousands of securities selling to smaller investors. It's still large compared to ordinary households, but relatively smaller investors. Whereas bank loans, we're talking about governments borrowing money from only a few multinational banks, right? So in this case, when it comes to default, right, sovereign default, if the country have a lot of bondholders, right, hundreds of bondholders, to negotiate with them, you can imagine it's going to be really costly, right? So you need to ask them, talk to them, hundreds of different people, they all have their own opinion. It's hard to come up with one agreement, right? But when it comes to only a few bank loans, like banks, multinational banks, the process can be a lot faster and cheaper. So that's one of the contributing factor for having more debt rescheduling, no repudiation. And another thing is because those loans are held by powerful banks, they are able to impose these cross-default provisions on the loan agreement. So cross-default provision says if the country default on one loan, they automatically default on all of their foreign loans. So the purpose of this provision is to prevent a dodgy government, from selectively default on weak lenders, right? So sometimes, especially happens to countries with very corrupted governments, they may sometimes when they find financial difficulties to pay the debt, they may think that, well, these bunch of lenders are small financial institutions, they don't have much power, I will choose to default on them, and I still continue to pay that for the other powerful lenders. So cross-default provisions prevent that kind of things from happening. So, and also, those big multinational banks are backed by their own governments, right? So their government's going to put political pressures on the country as well, because if they do take advantage of banks and claim default, those banks will have to realize huge losses, which is not good for the hosting country's benefits. So that's just a little bit discussion about the improvements in the global sovereign debt market. All good so far? Any questions? All good? All right. So now let's move on and talk about how do we measure sovereign risk of a country, right? So we can use external evaluation models like these indices. So there are organizations who provide this kind of services. So they keep updating, they analyze different factors about a country, and they publish a score. So these are the 3 most commonly used indices in the industry. And after that, we will also talk about internal evaluation model, where the bank use credit scoring model, which we learned a few weeks ago when we go through credit risk, to estimate country risk, right? So this time we use country level data, use the same statistical methods to come up with a country level score, right? So that's the whole idea. So just give you an idea about how these indices look like. The Euro Money Index, so it's calculated based on multiple macroeconomic and political factors. And this is a table provided by the textbook about how they classify different countries into 5 tiers by their Euro Money Index score. So I can't find any updated figure for the index because they all require subscription, so you need to pay for the data. But I do find a graph on their website. So they provide this world map where different countries are being classified into different tiers. And you can tell Australia, Canada, amount tier 1, so the lightest color, right? And then we have the US. The US should be maybe tier 2, slightly light, but darker than Canada, right? We also have China. Is it 2 or 3, right? And those African countries, a little bit of the South Africa, America, and the and around here, they all have like about 5, right? So the most risky countries, the Middle East countries. All right, so that's just a little bit idea about this. The second one is the Euro Economist Intelligence Unit Rating. So basically, they give you a score ranging from 0 to 100. The higher is the score, the greater is the risk. So as you would expect, Syria, Somalia, Venezuela, most risky country. Switzerland, Singapore, Sweden, very safe, right? Institutional Investor Index. So this index is a bit special. Basically, the organization send out surveys to institutional investors who involve in sovereign debt borrowing and lending business around the world, and ask them what do they think about a certain country's risk. And then they summarize their responses and come up with a score, this IIR score, triple I score, right? So again, if you look at the general category, still Switzerland, Norway, Sweden, Germany are the most safe country, whereas Somalia, Zimbabwe are the risky countries, right? So so that's just something about the index. So basically, the bank pays money to these organizations, so they provide up-to-date data for the banks. Or the bank can use their own statistic model. So if they have some data, some country-level data, they can use those data to come up with an estimation by themselves. So essentially, the whole thing are exactly the same as what we've talked about before, the credit scoring model, right? So essentially, we run regression using several factors. Remember, these factors are all at country level. So talking about a country as a whole, how much are their imports, exports, and all that. And you run regression and you estimate the weights for each of the factor, and then you calculate a score for each particular country, right? So the next thing we're gonna do is I will go through each of these, the 5 most commonly used country-level factors that helps banks explain a country's probability of rescheduling. And what you need to know is the correlation between each of these ratios with a country's probability of rescheduling and the reason for that, right? So start with debt service ratio. So it's calculated by adding interest rates, amortization on the debts over exports. So exports provide very good source of hard currency for a country, right? So it's the income a country can earn from selling their goods and services to foreign countries. and they generate hard currencies for the country. When we talk about hard currencies, basically we're talking about US dollar, British pound, Japanese yen. Okay? So those currencies with stable value, which you can use to pay foreign debts. Okay? So, but here we're looking at how much of the debt the bank needs to pay, the country need to pay relative to their hard currency income, export revenue, right? The higher is the ratio, the worse, right? So they will find it hard to repay their foreign debts. So there will be a positive correlation between the ratio and probability rescheduling. Import ratio. So import is the flip side of export. So import is how much the country needs to spend to buy foreign goods and services. So it consumes a country's hard currency reserves, right? So here we look at how much the country spent relative to their total foreign exchange reserves. If this ratio is higher, it means the country will have less ability to repay their foreign debt. So a positive correlation with probability rescheduling. Investment ratio is a bit different. So on the one hand, investment ratio, so real investment relative to gross national product, right? So remember macroeconomic 101, where we talk about how if a country have more real investment, they will have stronger economic growth in the future. So in that case, they should have stronger ability to repay their debt, right? So then it should be negatively related to a country's probability rescheduling. But sometimes people might argue that if a country spends too much time on their domestic real investment, they may run out of money to pay foreign debts, right? Another possibility is, especially happens when the country's government is quite corrupted. Sometimes the country will think that, well, in the future I'm going to have strong economic growth, which means I will be less dependent on foreign debt, right? So then I will care less about my reputation today. I will just default on the debt to make my life easier. Right? So those factors might contribute to a positive correlation between investment ratio and probability rescheduling. So it's hard to tell whether investment ratio have a positive or negative correlation with probability rescheduling. It could be either positive or negative, depending on what data you use. And we also have variance of export revenue. So this one should be straightforward, right? So the more volatile is the value of a country's export revenue, of course, the riskier for them to repay, right? So during bad time, if they can't generate enough export revenue, they have a high risk to default, right? So that's this one. The last one, domestic money supply growth. So we are talking about how much money the government prints every year, right? So again, this is related to macroeconomic 101. So when a government prints a lot of money, that's what happened in Zimbabwe. They experienced very high inflation, right? So so that means the next thing happens, the country's inflation is going to be very high. So if a country have high inflation, what next thing will happen? The value of their currency going to depreciate. So relatively speaking, the value of their foreign debt going to increase in value, right? So they will find it harder to repay their debts. So in all, domestic money supply should have a positive correlation with a country's probability rescheduling. Make sense? All right, so let's have a look at this example. We have two countries, Netherlands and Singapore. Netherlands have a variance of export revenue 15%, Singapore 28%. And part A says if you based on this 15 and 28%, which country should charge a higher risk premium? Which country? Netherlands or Singapore? Singapore, right? So Singapore have a more volatile export revenue, so saying that they have greater chance to default on the loan. Yes. But if we look at other information provided in the question, so if we run regression and estimate the correlation between the two countries' variance of export revenue with global average, right? So the beta, Netherlands have a beta of 0.8, Singapore have a beta of 0.2. So what do we mean by, so how do we interpret this information? Netherlands have a higher beta, right? So the correlation between Netherlands' variance of export revenue and the global average is higher. What does that mean? Systematic risk is of Singapore is lower. Yeah, so essentially it means when there is something wrong happens around the world, right? Netherlands will be affected more, whereas Singapore will be affected less. So in that case, if you consider constructing a portfolio, which one is going to provide more benefit? Singapore, right? So Singapore going to provide higher diversification benefits because even there's something wrong with global economy, Singapore actually are affected less, give you relatively more stable income, right? So the point of this question is just to tell you, even though certain countries might be risky, if we look at their scores or their certain risk factors, it might be risky, not a good investment. But if you consider their diversification benefits in your portfolio, it can be a good investment, right? And this is why, although a lot of developing countries have quite high risk, a lot of investors still love to invest in LCD loans because they actually offer very high diversification benefits for the bank's portfolio. And this gives rise to actually one of the problems with the CIA model, right? So if we simply focus on the statistical CIA model alone, you will ignore the portfolio aspects of analyzing how you construct your portfolio, right? So that's one of the problems with CIA model. Some other problems associated with the model include the difficulty of getting data to estimate the ratios we talked about just now. If you think about calculating those ratios for, say, Syria, right? Syria is having civil war and the country is basically not operating at the moment. We can't really get the GDP for the country, right? So similar things applies to some other countries. So sometimes we may not have enough information to get accurate prediction. Another thing is about population groups. So some countries may have default in the future before or kind of like that. The thing is, how do we distinct between reschedulers and non-reschedulers, right? So some countries, even though they've never default before, if they have a very bad current circumstances, they may still have a high chance of default, right? And other things that we ignore in the model include political factors like strikes, corruptions, elections, revolution, as well as corruption index, right? So that's just a little bit about the problems with the model. And this slide is talking about how when the bank think about rescheduling of sovereign debt, they need to think about it qualitatively. So they need to think about what are the benefits and the costs from the borrower's perspective as well as from the lender's perspective. So the idea is if you think about the borrower, what are the benefits and the costs for them to declare sovereign debt default, right? So the benefits would be they're going to have a better life today because they don't need to worry about the loans, right? But the costs can be really high. They will face very, very high reputation problems, right? So no lenders will trust the governments anymore. they will find it really hard to borrow money in the future. So these are the costs. For lenders, the costs are straightforward, right? So they will lose principal and interest payments from the loan. The present value of the loan going to decrease. They have to realize huge losses. Sometimes it might threaten their solvency, right? But if you think about benefit, so you're probably wondering how come there are benefits, right? So if the borrower default, there's no benefit for us. But at least if you agree to reschedule the debt, you know that you're gonna get something in the future. It's better than nothing, right? So a little bit is always better than nothing. And also during the negotiation process, sometimes the bank is able to earn very strong negotiation power. So the bank would say that, well, if we have this situation in the future, you need to give me more kind of like subsidies or tax concessions if I want to do business with your country, kind of like that, right? So negotiation kind of benefits. And also they can enjoy some sort of tax benefits from realizing losses on the debt. Makes sense? So this one is talking about how if we have an estimated model, you need to be aware that those coefficients changes all the time. And actually, we've talked about this before when we talk about credit scoring model. So a little bit more is we can actually infer a country's sovereign risk from market data as well. So if we look at the price and yield of a country's government bonds trading in the market, we should be able to have some idea about the country's sovereign risk. And basically, there is a secondary market that trade sovereign bonds. And if we look at performing and non-performing LDC loans, you should also have some idea about what's going on in a country. So if a country's loan is performing very well, so paying interest and principal payments on time, so we usually call them performing LDC loans. So they represent that the country is operating very well. Non-performing LDC loans, we also sometimes call them junk bonds. So they are loans that haven't generated any interest payments and principal payments for a while. So basically under we can say default status, but not default, is just delaying payments, right? So those loans are usually traded at a very, very low price, huge discount. And a couple of things banks can do if their foreign sovereign debts have default, right? So one thing is the bank could say, well, I'm going to sell the loans to someone who is willing to buy. Of course, you will need to sell it at a deep discount, and sometimes you may not be able to sell it anymore, but it's still an option. Another option is loan for bond swaps. So the idea is if we have a bank loan with a foreign government, right, we can try to swap the loan into bonds. Bonds have a secondary market where we can trade them and sell them, right? So in that way, you somehow gain some liquidity from this kind of swaps. And they can also choose from that for equity swaps. So there is a very famous example about how the Citibank successfully converted their Chilean government loan into equity in IBM. Right? So the idea is there were a time when Chilean government found difficulty to pay this 100 million worth of loans to Citibank. So what Citibank did was they sell the 100 million loan to Merrill Lynch for 91 million. So they realized the 9 million loss, right? But still they get majority of the money, right? And then Merrill Lynch sell that 91 million loan for 93 million to IBM, right? So they earn 2 million from that. So the question you want to ask might be how come IBM is willing to buy the loan, right? So this is because IBM is planning to to establish a plant, maybe a factory in Chile. So what I think it comes to the IBM negotiating with Chilean government, like, I need this piece of land for free, so I will settle the loan for you. Right? So kind of like that. Give me cheap labors, give me land, and I will settle the loan for you. So kind of like that. So another option they have is multi-year restructuring agreement, and this is happening. I think this is a way to settle the European debt crisis in the past few years. So the government negotiate with the lenders, write a new contract, multi-year contracts, like saying that this year I'm going to give you that much, and the following years for the next 10 years, 20 years, kind of like that. So usually it will involve a fee charged by the FI for restructuring, and the interest payments on the loan will also be changed, and usually the loan will have a longer maturity, and the government also needs some sort of guarantee. All right, that's everything about sovereign risk. Any questions?
We'll say restructuring the loan, the interest rate has changed from
Depends on how they negotiate it. Sometimes the interest rate can be lower recently and then increase in the future. Depends on how they negotiate the contract. The contract can be complicated, because we're talking a multi-year restructuring. So it can changes depending on what the country can offer. That's a really good question. Any other questions? Oh, good. All right. So that's sovereign risk. Okay. So then let's move on to securitization. Right? So actually, when I first hear about this word, when I was doing bachelor, I was so scared. The words seem so fancy, right? And it gives you an idea that the process can be really complicated. It's so confusing. So don't worry about that. It's not that hard to understand. So today I will use a couple of animation and photos to show you how the process works, right? So let's just start with, so what we're going to do is I will briefly introduce comprehensively introduce how the technology works, and then we will talk about different forms of securitization and the nature or different behaviors or characteristics of securities issued from the process. So generally, securitization is a very recent financial innovation. I think it only first comes during the 70s in the US. And in Australia, we have that securitization going on until the 80s. So it's very new financial innovation. And it's also related to shadow banking, right? All right, so I will try to make the process clear. So let's start with the ordinary business of a bank. Right? So think about, when households want to buy cars, want to buy houses, they usually come ask for a loan from banks. Right? So think about, let's say to buy this house, right? You want to borrow $1 million from banks. Let's say you sign a loan contract with Commonwealth Bank. So it's going to be a piece of paper, a home loan mortgage contract, and you will write $1 million on the contracts, your name, the bank's name, and all the details. Right? And another thing is most mortgage contracts are amortized loans, so which means take the $1 million plus the interest payments. You do a present value annuity, calculate equal payments, monthly payments. You need to pay every month to the bank for the next 10, 20 years. So that's the term of the loan. And basically, it will specify that today, once you sign a contract, the bank will pay $1 million cash to you to pay the price of the house, right? And what are you going to do in return? You will pay, like I said, the amortized monthly payments to the bank. And one thing you need to remember, the monthly payments will include part of the interest payments, part of the principal payments, right? So let's just call them principal and interest payment, P and I's. And remember, we're talking about Commonwealth banks who is writing a loan contracts with hundreds of households every month, every day, right? So let's say the bank has accumulated 1,000 pieces of home loan like this. So we're talking about 1,000 million, 1 billion worth of home loans, right? So Commonwealth Bank have 1 billion worth of home loans sitting on their balance sheet. What are the problems? If you are Commonwealth Bank's manager, what are the problems you need to know about? In particular to this 1 billion worth of home loan. If some of the households default, they're going to suffer loss? Yes, exactly. Default risk, credit risk, right? Anything else?
Actually, if they default, what we get is just the property.
We can get the property?
Yeah, the property is very hard to sell property like GFC.
It can be hard to sell, yes. So you can realize losses over there, yes. Any other problems? So we're talking about when bank lend $1 billion worth of money to the households, right? So $1 billion of cash have been converted into 20, 30-year maturity kind of investments. So very, very high liquidity mismatch problem. And for Commonwealth Bank's majority of their funding comes from deposits, right? So liquidity is a problem, yes. Anything else? Market risk, what kind of market risk? When there is economic downturn and crisis. So when there is a financial crisis, bank would mostly worry about household default. Okay, so that will be credit risk. For market risk, it's a good thought, but for market risk, what I want to say is, remember how did we define market risk in our costs? So we're talking about the risk that the bank gonna face when they actively trade assets and liabilities. Here, for home loans, most banks hold them until maturity. So there isn't much market risk here. Yes. Anything else? So essentially, what we are doing here, we're summarizing the costs, right? So it's basically what we do throughout this semester. So we talk about credit risk, we talk about liquidity risk, anything else?
Interest rate risk.
Yes, a bit more about it?
You can miscalculate the interest rate they charge to every household or to every mortgage.
Miscalculate? So on the right avenue, but how can $1 billion worth of mortgage loans come up with interest rate risk? What is the root cause of interest rate risk on that scenario? Any idea? Interest rate risk? When there is a change in interest rates, what will happen to the balance sheet of this bank? If it's a fixed term mortgage, yes. So if it's fixed term mortgage, yes. If market interest rate increase, the bank will receive less. So basically, there are two. So one thing is if market interest rate changes, it can affect the amount of money the bank receives from households, right? But that's not the biggest problem here. What's the biggest problem? But at the same time, the bank's funding cost is also lower. So that's not the biggest problem. What's the biggest problem? Actually, we spent 2 weeks on interest rate risk, so I'm asking you a tricky question here and need a more professional answer. When we talk about interest rate risk, what's the biggest problem? We have a 1 billion worth of assets, risky assets, with maturity 20, 30 years. What's the biggest problem? There is a change in interest rates, the market value of the bank's asset portfolio will be affected significantly. And we're talking about a very, very positive duration gap, okay? Duration mismatch problem. So the bank's raising cash from issuing demand deposits, and they are lending the money to home loans with 30 years maturity. So the biggest problem is we are having a very high duration mismatch problem, which means when there is a change in interest rate, it will affect market value of the bank's assets significantly. Right? So anything else?
The bank could sell its security, for example, by using ABS and the CDS and CDO. For
Yeah.
example, in US, like during the GFC.
So that's something we're going to talk about next. Okay? So we're not there yet. Any other things, any other problems associated with this 1 billion worth of mortgage pool in particular?
Using securitization to sell their security, and then we provide this kind of loan to consumer. And people who create a financial model like during the GFC, and a lot of stores has been sold. That the net problem is like there is not enough liquidity.
Yeah, so you're talking about the risk of the securitization process itself. Okay, so yeah, we'll definitely talk about that. But at the moment, like my question is, if you're a bank manager that managing $1 billion worth of bank loans, what are the risks and costs associated with that? And I can give you a hint. What have we talked about last week? And just now at the beginning, I actually give you a brief review as well. Capital adequacy, yes. So about this loan, what's the problem? Exactly, right? So this asset pool is very risky, and remember, on average, mortgage loans have a risk weight in Australia. It's about 20-30%. So 1 billion times 20-30%, that's the risk-weighted asset you put at the denominator. So bank will need to raise a lot of capital in order to comply with the minimum capital adequacy requirements. Okay, so they are associated with very, very heavy regulatory tax. And not only capital adequacy requirements, for some countries there are also cash reserve requirements, right? And there are also deposit premium insurance premium that the bank needs to pay to the central bank for raising enough deposits to fund this mortgage pool. Okay? So altogether we call them regulatory tax. So in summary, if you are a bank manager that manage $1 billion worth of home loans, you're probably gonna look like this. Okay, so a lot of problems you have to worry about every day, and they can be very, very problematic. But another thing I want to emphasize is actually providing home loans to households is a very attractive business. The interest rate charged on home loans are very reasonable. Like for investors, it's quite attractive. And banks also charge very high fees for providing the service. So they, at the same time, they provide very sufficient, very high profits for the banks, but they also come with all of these problems, right? So now let's talk about how we can help bank solve these problems, right? So we have all these problems. Let's say we have a smart guy, so he's bald and he's with glasses. He must be smart, like the professors at our school, right? So he come up with the idea. So he says, I understand the banks having problems because of all these issues we talk about. What about, and I actually know a bunch of people who are really rich. They have a lot of money. They want to make an investment to make more money. So they look at the housing market and they tell me, I want to share part of the profits from the housing market. I want to be able to enjoy the high interest rates in the housing market. But the problem is they are small investors. They are not qualified. And there are actually very strong regulations in the housing market, like in terms of who can provide loans to the general public. Only big institutions, commercial banks can do that. They can't, right? So that's why they can't be part of the loan initiation process at all. So what I'm going to do is I will innovate or issue new securities. Let's call them asset-backed securities, right? So there are a bunch of papers, contracts. I will sell these papers to these rich guy, right? So in that way, so I give them these pieces of papers, and this rich guy will give me money, cash, right? And use their cash, I will be able to buy the entire asset pool, the $1 billion worth of home loans from Commonwealth Bank. So you see, so basically what the smart guy doing is he spent $1 billion to buy the entire asset pool from the bank. Where the money come from? From he selling the asset-backed securities to rich investors. If that makes sense? So now I'm talking about the securitization process, how it starts and what's going on. Okay, so here we issued new security. We package all the home loans all together, package it, and backed by this asset pool, we issue new securities. Right? So now to make your mind more clear, let's talk about the incentive for like what will happen for each of the three parties. Right? So start with the banks. So if you are the bank manager, what will happen to you? Right? So essentially, you've sold that big problems to the smart guy. So now you have cash. How wonderful is that, right? So you've successfully sold this illiquid asset, risky illiquid asset to someone else, and you convert them to cash. Basically, these things will become off balance sheet, right? So they will not exist on your balance sheet. Now you have heaps of cash. You can then do whatever you want. You can raise more home loans to other households, and you can do other type of investments. And essentially, all of these problems are gone, right? So you don't need to worry about them. So the bank manager will look like this. So excited, so happy, right? So convert illiquid assets into cash. What about these investors here? So what are their incentive to buy these asset-backed securities? So essentially, when they buy these securities, what they are buying? They are buying part of the ownership in this asset pool, right? And what are their return? They now start to receive principal and interest payments. So the idea is before households pay amortized monthly payments to the banks, Now the payments will be redirected to the smart guy, and the smart guy will redirect the money to these investors, right? So you are paying for an investment that promise certain monthly cash flows to your pocket over a fairly long period of time. Make sense? And I want you guys to think about what are the risks faced by these investors. Yes, exactly. Credit risks are still there, right? So we're facing the same set of households. They all have a probability to default. Any other things? We probably still have some sort of liquidity risk, but the liquidity risk can be significantly reduced because these asset-backed securities have a very liquid secondary market to trade. And there will be no regulatory tax anymore because they are smaller investors. They are not subject to capital adequacy requirements, deposit insurance, and all that. So no regulatory tax. In terms of duration mismatch problem, depend on where these investors get their funding. So if they're funding a fairly long term, they probably don't worry too much about duration mismatch problem. At least not as much as Commonwealth banks, the depository institutions, right? So you see how through the process, it generates values for everyone, right? So banks happy, the investors are fairly happy, they get to share part of the benefits in the housing markets, right? So that's how securitization generates values for everyone, and that's why it's so popular. And now let's talk about the middleman, the smart guy. What's his incentive to do all of these things, right? So smart guy can choose from two different business models. SPV, Special Purpose Vehicle, or SIV, Structured Investment Vehicle. So let's talk about SPV first. The smart guy could say that, well, I don't want to engage in any of the risk in the process. I only want to be a middleman who provides service. So what he will do is he will be part of that 1 billion asset pool, work with that pool, and he will provide service like communicate to the banks, communicate to different investors, help with the issuance of the securities, and he will also pass all the payments from banks, from households to the investors over time. And to do that, so all of those services are not provided for free. He will charge a fee, so percentage fee out of these cash flows over time. So receive a fee, redirect principal and interest payments for investors, that's all. No risk taking, only charge fees. So that's SPV. And the life of SPV will be very limited. It's tied with this asset pool. So after 20 years, once all the home loans are being fully repaid, this SPV will disappear. Okay, so that's SPV. About SIV, so special guy can have a second choice. So he could say that, well, I want to be part of the process. I want to be rich, right? So what I'm going to do is I'm going to establish a company, an independent entity. So what I will do is I will go to not only Commonwealth Bank, but Westpac, NAB, other St. George, different banks, and buy their mortgage pools over time. And at the same time, I will issue security called asset-backed commercial paper, guarantee the contract under my own name, sell them to investors. So you see how he play around in the two sides. So on the one hand, he looked for different mortgage contracts from different banks. On the other hand, he raised money from selling commercial papers. So if he can organize both sides well, if he can sell the bonds at a better price, if he can buy the mortgage pool at a lower price, he earns a spread, right? So in that case, he not only earns a fee, he also earns any spread he can create in the middle. But of course, he also takes risk. If there's something wrong with the market conditions, some crisis, he probably can lose huge amount of money. But at the same time, because it's an independent entity, it will theoretically it have an unlimited life. You can keep operating forever. All good so far? Any questions about the difference between SPV and SIV? No? All right. So now let's talk about other parties involved in the process. So now we talked about the smart guy who provides the service, right? The bank, the households, the investors. In practice, a lot of other parties are involved in the process as well. Any idea who could they be? Investment bank, or what type of things they can do? ABS. Well, I think you're talking about the smart guy.
Actually,
Yeah, right. Any other parties involved? The government. So what do they do?
Tax and regulation.
Tax and regulation. Yes, that's something you do. And actually, I can tell you, government play a even more active role in this process. Some government agents, they actually sponsor and help facilitate the issuance of the securities. So later on, in a couple of slides, I will talk about how government sponsorship works in the process. Right? Yes. Anyone else? A little bit hint. So we're talking about the issuance and the selling of new securities in the financial market. During that process, what are the services we need? Yes, we need some sort of guarantee or insurance kind of services. We also need underwriting services. So someone who's willing to wholesale, like buy some of the securities and then sell them, distribute them over a longer term to different investors. Who else? Credit rating agencies, exactly, right? So they are new securities, investors don't know what's the risk. We need some authority to provide reasonable ratings so investors know what are the risks, right? Credit rating agencies. And also, we are talking about millions of dollars going through every month from this side to investors, right? And it will be passed through to the smart guy. You can't trust any individuals who can responsibly handling those money, right? So we need trustees. So we need trustees to safeguard those cash flows and redistribute those cash flows to different investors. So these are some of the parties that could involve in the process. All right, what about we have a 10-minute break, and then we can come back, try to formalize what I said into statements, paragraphs on the slides. All right. You all look so tired and sleepy. What about I play some music to wake you up? Is that a good idea? Yep. Any recommendations? Any song you want to hear? No? So then I will have to choose my what I like. Maybe you won't like it.
lender may need to replenish its funds sooner than the borrower can pay back the loan. That's where Fannie Mae comes in. We purchase the loans and give the lender cash in return. These are known as whole loan purchase.
So you see, basically here, Fannie Mae is just acting as the smart guy. Right? So either SIV or SPV kind of role. So they buy the mortgage from lender, basically the banks, and they give banks cash.
Another option? The lender sends us a group of loans and we swap them for mortgage-backed securities.
So they can also give banks mortgage-backed securities if they don't require the money urgently, right?
The lender can keep the MBS for its portfolio or sell to investors. This is the process known as securitization, taking a home loan backed by an asset like a house and transforming it into a security. Let's look at how it works. Just like any manufacturing process, raw materials are combined to make something new. In this case, information is gathered by the lender to qualify the buyer of each loan and the information about the loan. All of that data could be considered the raw material. A lot of data. More than 200,000 loans go through Fannie Mae securitization systems every month. The first step of this process is called issuance. It starts right after the loan is delivered to Fannie Mae. Data are validated through a thorough automated process. The mortgage note and other documents are also delivered for review and safekeeping.
So this is talking about when banks sell those mortgage loans to Fannie Mae, right? They will collect all the information about the loan. They process the information, the data they talk about, and determine what mortgage loans are safer, what mortgage loans are less safer. And then they only include the safer mortgage loans in their pool to create pass-through securities.
If everything checks out, the loans continue through the manufacturing process. But if information doesn't match or meet Fannie Mae's selling requirements, we work with the lender to resolve these differences. When these exceptions can't be reconciled, the loans are dropped from the process and returned to the lender.
So you see how they make sure the pool only include safe mortgages, right? So you have a better chance, the investors have a better chance to receive the cash flows over a fairly long period of time.
Now, this pool of clean loans goes through even more steps before the MBS can be issued. Remember those whole loans that a lender sells to Fannie Mae for cash? They are now in Fannie Mae's portfolio and can be pulled and pooled to produce new mortgage-backed securities using the same MBS issuance process. Fannie Mae can keep these securities or sell them to investors. We share information at the time any MBS is issued, so investors can understand the risk. But we're not finished yet. Fannie Mae has an ongoing relationship with both the lender and the investor. The lender continues to service the loan, collecting payments from the borrower, and sends principal and interest on to Fannie Mae after keeping a servicing fee. For MBS, Fannie Mae passes that principal and interest through a trust to the investor. Since Fannie Mae guarantees to the investor timely payments of principal and interest, we receive a monthly fee. Finally, as part of the bond administration, the trust agent releases funds to pay investors who own the mortgage-backed securities. Ongoing disclosures for MBS are published monthly, so investors can see the current status of the security. That's how the securitization process works, connecting borrowers, lenders, Fannie Mae, and investors to fund the hundreds of thousands of mortgages needed every month in the U.S.
Makes sense? And I think I was wrong. So when you asked me whether the government could invest in, you see, so they are actually one of the investors who invest in mortgage-backed securities. Yes, and also I think in the U.S. when the central bank tries to save the market after GFC, they actually announced what that called. They actually about a lot of long-term securities, like monetary easing policies. So they do bought. Yes, I remember. They do bought invested in a lot of mortgage-backed securities. Yes. All right. So that's in Australia, right? So remember we had securitization during since the 80s, and these are the government sponsors from different states that initiate and issue pass-through securities. So this is something I've mentioned earlier. Mortgage or home loans, they are amortized loans. So which means given the size of the loan, you need to use the present value annuity formula to calculate the constant monthly payment the household need to pay. On the other hand, the investors can receive every month, right? And another thing you need to be aware is this constant monthly payment include part of the interest and part of the principal. And at the beginning, at the first few years, the amount of principal will be very little, right? The amount of interest payment will be very high for the fraction of each monthly payments. This is because their principal outstanding is so high, you need to pay a lot of interest. At the later life of the contracts, of the mortgage loan, out of the same constant monthly payments, more will be principal payments, less will be interest payments. So I assume you guys know how to calculate interest payments and principal payments out of a monthly amortized loan payment, right? So that's something you've learned in like bond pricing costs. So basically, so this is something I've said just now. So that's pass-through securities and some issues with pass-through securities. Another thing actually I've talked about is if you think about pass-through securities, like I said, price of these securities are determined by cash flows. So present value of future cash flows determines the value of these securities. And theoretically, as investors of ABS, if nothing wrong happens, right? If all the households pay the payments and there's nothing wrong, every week the investors expect to receive the same amount of payment every month, right? So for a reasonable period of time. But in reality, it's not the case, right? So under very severe market circumstances like crisis, some of the households may default. So which means sometimes this principal and interest payment may be less, so investor will receive less. But sometimes, most of the time, if there is no crisis and a reasonable fraction of households pay their loans, most of the time there will be circumstances where investors receive extra payment, and that's what we call prepayments, right? So prepayments generally happen under a couple of scenarios when they refinance their mortgage, when household refinance their mortgage, or when they do house turnover, or some other reasons. For example, maybe dad got promoted, got a new job, we have a lot of income now, we want to get rid of the loan faster, so we pay more, okay? So prepayment. So we pay more than what's required by our loan contracts. And another thing is house turnover. So maybe we move to a different state or to a different country, we want to sell the house and get rid of the loans straight away. So that's going to lead to prepayments as well. Another very common factor that lead to prepayments is loan refinancing. And this is especially severe during period of low interest rates. And it's exactly what's happening in Australia during recent years, right? So when market interest rates are low, what will happen is those old mortgage holders, they will think, well, interest rates are low. I should take advantage of it because I need to pay less interest payments, right? So I should restructure my loan, take advantage of the low interest, and pay more, right? Because I have the ability because interest rates are low, right? So because of this, so most of the time during period of low interest rates, investors tend to receive more prepayments. And now let's talk about benefits and costs of prepayments. Okay? So what are the benefits and costs of prepayments? From the investor's perspective. So if you invest in pass-through securities, You receive monthly payments generated from the mortgage pool. Sometimes you receive more. What are the benefits? What are the costs? Any idea? Benefits should be straightforward. You have an investment that generates extra cash flows earlier. That's good, so good, right? So the present value of your investment is going to go up, and the risk of the investment is going to go down. You don't need to worry about future default risk because you receive more earlier, right? So the good thing is present value of your investment will go up. You receive more cash flow earlier. You can make more investment out of those extra cash flows. What are the problems with prepayment? Yes, so it's not about inflation, but it's rather about the return, right? So the idea is think about it as if you're a long-term investor who expect to receive constant cash flows, which carries sometimes for mortgage loans, the rate is quite high, 7%, 8%, right? Over 10 years, that's a very good investment. That's why you buy the pass-through securities at the beginning. But when you realize that you actually start to receive extra cash flows earlier, and remember, those extra cash flows comes when market interest rates are low, right? So when you two things will happen. When you try to reinvest those cash flows at market interest rates, remember it's low. So your return gonna be less than if the money are kept in the investments. The second thing is like what you said. We're expecting a 7% return from our investment. Now, with people start to prepay, they pay more principals, which means in the future, you will receive less interest payments, right? And which means you will no longer enjoy the 7% return anymore. Yes, so that's the bad thing about prepayments. And because prepayments provide, lead to uncertainty to investors, some investors do not like this uncertainty, and when it comes to the valuation of these pass-through securities, it will be affected. Okay? So here are the summary of, so this is a graph that shows you the probability of prepayments with decrease in increase in interest rates. In reality, in practice, when interest rate increase, people do not prepay, right? When interest rate decrease, there will be much higher probability of prepay happening in the market. And this is just summarizing the good news and the bad news about prepayments. So, so what I want to emphasize is, because of these prepayments, right, like I said, the value of these pass-through securities will be affected because some long-term investors do not like that. What the smart guys think is, well, that's not good. I want to sell these securities at a better price. I want all different types of investors to enjoy the benefits provided by securitization. I don't like this prepayment risk. How do we deal with it, right? So smart guy says, let's initiate the second form of securitization, the CMO or CDO, collateralized debt obligation, collateralized mortgage obligation. So smart guy says, well, if some investors do not like prepayments, well, prepayment is not evil, right? It brings benefits. So some investors may like prepayments, some may not. So what about, so it's just like imagine you have a cake. So half of the cake have one flavor, the other have the other flavor. Originally, we will mix the cake, cut them into equal fractions. Now, smart guy says, what about we cut the cake in different ways, so different flavors go to sell to different investors, depend on their preference. So in this case, everyone are happy, they are happy to pay better price. for these securities. So how do we do that? Let's create 3 different tranches. Okay, so class A, B, C, or tranche A, B, C. So what are we going to do is every time, despite the ordinary monthly payments, so the ordinary monthly payments will be equally distributed across class A, B, C bondholders. On top of that, every time when smart guy receives prepayments, he will only pass prepayments to class A bondholders. So that means class B and C bondholders rest assured that they are not affected by prepayments. They don't receive any extra payments, but only constant payments, right? But at the same time, you need to know that because class A bondholders are receive extra cash flows all the time, it means their principal is going to be drawn down faster. So they will mature faster. After class A bonds are fully repaid, then class B and C bondholders will start to receive prepayments. So in that sense, we can say that class A bonds will have the highest prepayment risk, but at the same time, they enjoy the lowest what risk? Default risk, exactly. So they receive extra cash flows, their maturities are short, they have the lowest default risk. On the contrary, class C bondholders will have the lowest prepayment risk, but they have a long term, they expect to receive the payments over a longer term, they will have higher credit risk. And if we talk about maturity of these securities, on average, class A bonds usually have a 1.5 to 3 years maturity, whereas class B have 5 to 7 years, class C greater than 10 years. So in other words, if you consider class C bonds, right, over the past 5 to 7 years before class A and B bonds are fully repaid, you don't receive any prepayments, right? So you keep receiving constant payment for at least 7 years, and then you start to have that prepayments. Make sense? And also, because class A bonds have lower credit risk compared to class C bonds, they usually require less coupon rate compared to class C bonds. So class C bonds will require higher yield. All right, so that's the ordinary tranches we talk about. Over time, smart guy come up with additional tranches. And I think in practice, nowadays there are mortgage pools that are securitized by 15, 14 tranches, even. A lot of tranches. So let's just talk about those special ones. So we can have class Z tranche or class R tranche. So class Z, the Z is short for 0, right? So it's kind of like a 0 coupon bond. When you invest in a class Z bonds, what will happen is you don't receive any cash flows before class A, B, C are fully retired. So for the first 10 years, you don't receive any cash flow. It's just like a 0 coupon bond. After that, you start to receive coupon payments. So a hybrid of 0 coupon bonds. Class R is also special. The R is short for residual. So class R bonds will always sit at the bottom of CMO facility. It's more like an equity tranche. So the idea is what you will receive as return if you invest in class R are anything that's left in the pool after all of the previous tranches are fully repaid. And any reinvestment income from reinvesting excess cash flows generated by the pool. Okay? So I want you guys to think deeper about the value of class R tranche. Right? So remember, class R loans generate cash flows including reinvestment income from excess cash flows generated by the pool and whatever left in the pool. So that's why it's called equity tranche. You have the residual claims. So that means, think about it, when market interest rate is higher, what will happen to the value of class R bonds? Any idea? Increase because you receive reinvestment income from those extra cash flows, right? The higher is the market interest rate, the more income, reinvestment income you receive. So you see, this is the most distinct feature of class R bonds. We have a bonds where the value goes up and down at the same direction as interest rates. Isn't that amazing, right? Most of the securities we talked about before, including class ABC, their price all decrease they all decrease with increase in interest rate, because when we price a bond, we do present value of future cash flows, right? So the higher is the rate, the higher is the discount factor, the lower is the price. But now we have a security that increase in value when interest rate increase and decrease when interest rate decrease. So if you think about duration of class R, what can be duration? What could be the duration of class R? Theoretically, what could be the value of duration for class R? For ordinary securities, where the price decrease when interest rate increase, their durations are positive. Okay? For class R, it moves in completely the opposite direction. Its duration gonna be negative. So now we created a security with negative duration. And why it is a very distinct and attractive feature? Think about it. Who will like class R? Any idea?
Credit rating with triple B
Triple B rating. Why that specific? Why triple B rating?
actually because triple A rating is to contribute to the lower default risk Z, and the left in the pool is contribute to R. It's relatively higher default risk.
Yes, I agree. Class R bonds can be risky. Yes.
Yeah, it sounds it should be triple B, some form that
It's not that. Well, they may attract a triple B rating by the rating agency, but I don't think, in terms of firms, any firm with specific rating would prefer or not prefer any type of securities. The decisions usually made by looking at their portfolio. So you think about it, for ordinary investment, our investment value decrease when interest rate increase. Now you have an investment that increase in value when interest rate increase. If you include class R in your portfolio, what will happen? Hedging, exactly. It hedges the value of your portfolio, right? So when interest rate increase, your other investment decrease in value, but class R increase in value, they cancel out. So the value of your portfolio gonna be more stable. They are very good hedging instruments to help commercial banks deal with positive duration gap problem. Okay? Think about it. If you include class R bound into Commonwealth Bank's balance sheet, when you calculate duration of Commonwealth's asset portfolio, you have a negative asset with negative duration. So effectively, your duration gap is gonna be reduced. Okay, so they are very good for hedging. All good so far? So here are some, so here is an example of how, in terms of how we distribute cash flows across different tranches. Here we have 150 million worth of asset pool, created 3 classes. Each have equal amount, and you see class A 7%, class B 8, not because class C is riskier. And in month 1, we received 1 million monthly payment and 1.5 million prepayment. How do we distribute these cash flows? Basically, the first thing you need to do is the facility, so the securitization facility needs to meet the promised coupon payments for each class bondholders. So that means you need to take the principal outstanding, multiply by the coupon rate, and calculate the coupon payment. So these are the payments that each class bondholders will receive every month, right? And so if you add the 3 numbers up, it will just be 1 million. So this is because of the design of this facility. So it happens that with 7, 8, 9, so the average rate is about, it happens to just give you 1 million of return out of 150. So if you divide 1 million by 150, that's just, hold on, I multiply by 12, yes. So it's just when you design the coupon rate, you make up the number so that exactly every month pay 1 million, the first month, right? It doesn't have to be this case in reality, but it's just, this is just designed in a way like this. And how do we deal with the 1.5 million prepayments? All of these payments will go to pay down principal of class A. So which means now the principal outstanding of class A will become 50 minus 1.5, so 48.5. And in second month, in month 2, when you calculate the coupon payment, you will need to use the lower principal multiplied by the coupon rate. So that means class A bondholders will receive less coupon payments in month 2 compared to month 1. Make sense? But for bond B holders and C holders, they will receive the same. Make sense? Any questions? All good? All right, so we've talked about the features of these classes. We've also talked, in practice, up to 17 classes have been issued. So we also talked about classes that are. And now let's talk about another special type of security called pass-through strips. So this time, Smart Guy says, let's separate principal payment from interest payment. And we will give principal payment to PO strip holders, principal only, and we will give interest payment to IO strip holders, interest only. So now I want you guys to think about how do we price these strips, IO and PO strips. So if you hold PO strips, what will your cash flow look like? You only receive principal payment from the monthly payments. Okay? So that means at the beginning, at the first few years, what will be the amount of the cash flow you receive? High or low? Low, right? Because principal outstandings are high. The monthly payments, majority of them will go to pay interest. Only small amount for principal. So at the beginning, if you're a PO strip holder, you receive very small cash flows and larger over time. Make sense? And if you are IO strip holder, it will be the opposite, right? So you will receive a lot of cash flows at the beginning, less and less in the future when the principals are being drawn down, right? So now, remember, when we price these securities, we do present value of future cash flows. So now let's talk about when there is a decrease in interest rates, what will happen to the price of these securities? And remember, when there is a decrease in interest rates, there will be prepayments. Okay? So let's consider the effects of prepayments and decreasing interest rate on your price. The first thing, PO strip, you receive principal payments all the time. When there is a decrease in interest rates, when people start to prepay, how much will you receive? You will receive more principal. Right? So when they prepay, they actually pay down principal payments, which means as PO strip holders, you will receive more cash flows earlier, right? When interest rates are low, remember? And when interest rates are low, when you do present value of future cash flows, what will happen? The discount rate will be lower. So consider the price of PO strip. When interest rates are low, you receive more cash flows, right? Price go up. At the same time, you discount all future cash flows at a lower rate. Price go up. So both effects gonna push up price of PO strip. So two effects gonna work at the same direction, push up price of PO strip. So this means that PO strip, the value of PO strip actually are very sensitive to changing interest rates, because every time when there is a drop in interest rates, two effects gonna work in the same direction to push up price or down the price of this security. Very, very sensitive to changing interest rates. Make sense? So this part gets a bit confusing. Any questions so far?
What's the motivation for PO investor? Because investor requires their asset because also we can interest our what PO investor receives only the principal payment. So what's the motivation for the
What the motivation? So any type of securities have its value. If it's reasonably priced, certain investors may invest in them. So if you consider the cash flow pattern of PO strip, you receive very little at the beginning and a little bit more in the future. So if you expect a match of cash flow like this, you may want to buy it. But it's actually, I could imagine maybe long-term investor. I don't need cash flows recently, but I need more cash flows maybe in the future. I will probably buy PO strip. So it just depends on whether you like this type of cash flow structure or not.
But what investor who receive just principal, no any interest?
No, I think you have a misunderstanding here. The principal, what we call principal, is the principal coming from the mortgage pool. But it doesn't mean when you buy PO strip, you don't receive interest payments. It carries coupon rates, and it's just an investment. So here, it's an investment that allow you to receive cash flows. The cash flows comes from the principal payments paid by households. So it's not like you're not receiving interest payments. You do receive interest payments. So here we're just talking about where your cash flow come from. They come from the principal payments. But all these instruments, they carry reasonable coupon rates. Yes. And yeah, so that's PO strip. Let's talk about IO strip. So again, let's do the same thing. When there is a decrease in interest rates, what will happen to the price of IO strip? It will decrease because it's totally opposite to PO strip, but not that totally opposite. So we need to still consider the two effects, right? So basically for IO strip, when interest rate decrease, we will receive more prepayments, but those prepayments are mainly for principal. So which means as IO strip holders, you will receive less interest payment in the future because principals are being paid early, right? So that means the number and amount of cash flows you will receive actually reduce. So in that sense, it will decrease the price of the IO strip. here, right? But remember, when we calculate price, we do present value of future cash flows, which means at lower rates, price actually go up, discount rates, right? So in this case, the two effects actually work in opposite direction in terms of how they affect the price of IO strip. So on average, duration of IO strips are very low, around 0. And if interest rates are very low, which triggered a lot of prepayments, which means we're going to receive much less interest payments. In that case, the effects of prepayments going to dominate the discount effects, then the value of IO strip will actually decrease with decreasing interest rates. So you see, again, we have a security with negative duration. So basically, IO strip is very special. It doesn't necessarily always have a negative duration. Under some certain circumstances, it has negative duration. So I will show you a couple of graphs, and I will also show you the pricing formula for the strips, and you will have a better idea. So for PO strip, this is the formula we use to price the security, right? So like I said, present value of future cash flows. So when interest rate decrease, these PO 1, 2, 3 will be greater, right? You will receive more. And at the same time, the denominator will be less, so making the price very, very positive. And if you look at the graph here, basically, when there is a decrease in interest rates, we will expect the price of PO strip to go up sharply. Okay? So you see how it's a very sharp downward sloping curve, indicating a very sensitive, indicating a very sensitive change to the price with respect to changing interest rates. For IO strip, similarly, present value of future cash flows, but this time we will receive less interest payments when there are more prepayments. So in this time, depending on how much is the current market interest rates, if market interest rate is below the coupon rates promised by the IO strip, so if this IO strip promises a 10% coupon payment, then if interest rates are below that rate, we will have a positive, we will have a negative duration. On the contrary, if market interest rates is above the coupon rate of the IO strip, it will be the opposite. So price of the IO will decrease when interest rate increase. So the idea is when interest rates are higher, there will be much less prepayments, which means the denominator gonna be affected much less compared to the denominator. So mathematically, it will lead to an increase in price when interest rate decrease, and vice versa. When there is a lower interest rate, prepayment gonna be much more, right? Which means the IO strip value, the cash flows we receive, gonna be much less. So that effect gonna dominate the positive discount effects, leading to a opposite pattern. Make sense? All good? Any questions? No? All right. So you see how, like I said, again, we have a security with negative duration, and it's a very good hedging security for the banks, right? So if you have invested in ordinary securities where its price decrease when interest rate increase, right? If you invest in an IO strip to cover the position, you see how here the value of your investment is completely stable. There is no interest rate risk. Okay, so that's how hedging works. But later on here, it will just decrease the value. Make sense? Yep. All right, so let's do an exercise. And now it's like a lot of information for you to absorb. So So we've talked about so many types of asset-backed securities. They all have their own features. Class A, B, C, Z are pass-through securities, IO strip, PO strip. So the question says, let's rank the 5 securities by their duration. So let's start with the lowest ones. So which one of these securities have lowest duration? Take a guess. B, residual tranche? Yes, very good. Remember, residual tranche have a negative duration, right? Shortest. Who else? Next? IO strip, exactly. So IO strip and class R are at the bottom, lowest duration, right? And on top of that, who will be the next? Second lowest duration. So we have PO strip, tranche A, and pass-through securities. Which one? PO strip? What's that? What's that? So which one of these? Not definitely not PO strip. No. So who will have the second shortest duration? Which one? Come on, shouldn't be that hard. So I've told you it's not gonna be PO. So we have pass-through securities and class R tranche, class A, tranche A. Which one? Tranche A and pass-through. Which one gonna have short duration? Tranche A, of course, right? Tranche A, remember, I've told you tranche A have an average life of 1.5 to 3 years. Really short, right? Their duration gonna be short. Whereas for pass-through securities, you receive the constant payments, right, all the time. So much longer maturity. So the second shortest duration gonna be tranche A, definitely. The next. So we have pass-through and PO. How do we compare the duration of pass-through securities and PO strip? Which one gonna be shorter? PO? No. It's actually pass-through securities. So there's one way you can think about it. If you hold pass-through securities, you are receiving principal and interest payments together, right? So which means when there is a change in interest rates, you have that interest payments with slight negative duration to offset with it. For PO strip, you only receive principal payments, and remember the discussion we had earlier. For PO strip, you see how it's actually very sensitive to changing interest rates. It have a very positive duration. So if we compare PO strip with pass-through securities, definitely PO strip gonna have a longer duration. So that's how we rank the 5. So we're ranking them from shortest to longest duration. So pass-through security, you could consider it as an average of IO and the PO. So it's gonna be in somewhere in the middle, right? All good? Any questions? All right. So, okay. So the last form of securitization, mortgage-backed bonds. Actually, I don't quite think this type of bonds are part of the securitization process at all. It's actually very simple. Besides the fancy name, it's very simple. So when bank want to borrow money, sometimes they can borrow money by like saying that I'm gonna issue this type of securities backed by my building, my office, right? So that's secured loans. We really talk about loans with collateral. Mortgage-backed bond is the same idea. So when banks want to borrow money, they tell the borrowers, they tell the lenders that I'm gonna use my mortgage pool as collateral. So that's all. So when banks try to issue bonds by using their mortgage loans as collateral, that's what we call mortgage-backed loans or mortgage-backed bonds. And you can think about it, when you use mortgage loans as collateral, they still sit on the balance sheet of the bank. There is no selling of the loans or anything. So there is no benefits that the bank can enjoy from the ordinary securitization process. They still sit on the bank's balance sheet, leading to huge regulatory tax, all of those problems. So that's why this is the least used securities form of securities used in around the world. I think only some German and European countries are still using mortgage-backed bonds. So so that's just a little bit about MBB. So extra notes, last thing. So basically, we finished talking about all of the details and the process of securitization, right? Overall, securitization is all about making illiquid, non-tradable securities into liquid, tradable securities. Right? So imagine we have a pool of mortgage loans where you can't really sell them in the market. So you package them, slice them into pieces, sell it to investors. There are very liquid secondary markets where institutions can buy and sell Class A, B, C, and all the different tranches. Right? So they become tradable and liquid. And nowadays, people become more and more innovative. So not only home loans, commercial loans can be securitized. We have credit cards that are securitized. We also have auto loans, student loans, other financial assets that are securitized. And out of all of them, I think the most interesting one is this celebrity bonds. And one of the most famous ones is the Bowie bond. So the idea is the celebrity, David Bowie, he's a very famous rock star during the 70s. So he had some financial difficulties, so he decided to issue Bowie bonds in the market. So basically what he did is he took a couple of his famous records, like songs, tracks, right? And he promised investors that if you buy Bowie bonds, you will receive all the royalties and incomes generated by my records in the future for the next, say, 20 years or something. And you give me money today. Okay? So that's kind of how you can actually securitize Bowie bonds, like celebrities' records and royalty income. And I remember there were a joke going on, I think last year or a famous actress in China got into like tax scandal, right? So the government fined the actress for paying 800,000 million cash for tax, right? So some people were joking that maybe she could issue some Bing Bing bonds. Right? So just like he can promise investors that I'm going to pay you from my income for the next 10 years for all the movies I perform, and you help me raise money to pay the tax bill today. Okay? So that's just a joke, but it's something that could be done nowadays in the financial markets. Right? So there is a video that helps discuss what happened when Bowie bonds were issued and some interesting things related to that. So hopefully you want to watch them at home. So that's everything I want to talk about today. Any questions? Nothing at all? All right. So this is the last lecture for this course this semester. I will hold a final exam review consultation tomorrow, Friday, at 2:30, level 3, 320, right, so the consultation room. I will be away next week, so if you have any questions after tomorrow, you may need to send me emails or post it on the forum. So if you have any questions or confusions, please bring your questions to the review consultation tomorrow. Okay? So after that, just wish you all guys best luck for the exams and the best wishes for your future career and the learning, like study life. So hope I can see you in the other courses. Definitely not this course next semester, right? So, all right. So see you guys around.
You're confused about that.
Mm-hmm.
The PO and I mean the duration.
Which one?
No, about that order. You mean
The order.
duration
Yes,
is
yes.
much larger than the.
Mm-hmm.
Yes, yes. The PO is larger than pass-through.
Yes. PO have a greater duration than pass-through.
Yeah, pass-through is principal plus the interest.
Mhm.
PO is just principal.
Yes.
And its amount is much larger. You mean the interest can offset the effect by the principal?
Yeah, because when we are talking about how sensitive the price of the security with respect to changing interest rates, so what I'm saying is, if you hold a pass-through security, essentially you are holding a combination of this and this,
Yes.
right? So you could imagine you are holding this graph plus this graph,
Oh, yes.
right? So if you combine this graph with this graph, so with changing interest rate, the price, for pass-through, it's gonna be this one plus this one. So you see how this is decreased, this is increased, so which means around here it's gonna be flat,
Yes.
right? So less sharper than this one. So in that case, we are actually facing a security that price change relatively less
Yes.
than PO strip.
Yeah, I understand.
Yeah?
Thank you.
Okay, no worries.
See you. Take care.
Next time.
See you.
你等会儿要在学校吗？
I have two questions.
Mm-hmm.
The first one is very personal. The lecture start around page 13. Yeah. It's an credit rating for some countries.
Mm-hmm.
Hong Kong is country.
I
I thought you just copied. No, I just told you this thing. And another thing is that this class, the course structure of that class, is nearly totally the same with another class. Do you know Financial 5550? It's kind of financial banking management. So in week 1 we study that kind of, in week 5 we study